Hello, this is Steve Sanangelo from the SRS Rock Report, and I'm glad you joined me today because in this video update, I'm going to discuss the important factors impacting the gold and silver supply and price. Now, what's interesting, most precious metal investors, even regular investors, do not understand the two different price functions of gold and silver. Now, we hear a lot about precious metal manipulation on the COMEX and the futures exchange, but which I don't disagree, but we have to understand there are two ways that the metals are being priced. Number one, they're being based as a commodity, and that's cost of production and supply and demand. And they're also based as a store of value. Now, I don't see a lot of manipulation taking place when they're based on a commodity, and I'll show you. This is where the manipulation is taking place, when they're based as a store of value and money versus all the other assets and debts in the world. Now, this is a recent YouTube video on April 13th by Harry Dent Jr. Now, Harry Dent Jr. has been talking about gold going down to 450 and 700 for years. Last year, he had to update it because he said it would never hit 450. And so I wanted to show you why the commodity price mechanism is important, because it gives us a floor in the metals prices, gold and silver. Now, he said, my target for gold, when we start to see a deflationary, when the markets start to really roll over, he says gold is going to go to 900 or 1,000, or we could see the 2008 lows of 700. Now, Dent makes these incorrect forecasts because he doesn't understand energy and he doesn't understand the cost of production as a floor in the prices. And I'm going to discuss this chart in detail towards the end of the video, so please watch the entire video. It's very important. Now, this is Barrick and Newmont's production cost versus the gold price. Their combined production cost is shown in the gold bars, and the gold price is shown in the little green money bars. Now, what's interesting, I thought because the oil price fell in the first quarter of 2020, the cost of production would be less than it was in 2019, but it actually jumped. It's the highest ever. So unfortunately, a lot of analysts like Harry Dent do not understand this. They just look at gold, the price of gold in charts. They have no idea what it costs to produce gold. Now, another thing that we should understand about gold and silver, the high quality store of value, is the fragile nature of currencies. Now, I've talked about this before, but I want to talk about it again. The gold coin on average will last about 35 years in circulation before it has to be brought back to the mint, remelted, and made into a new coin because it's been worn, the surface. But there really hasn't been much loss of gold. Now, the Federal Reserve notes that they make, they last on average 8 years. The digital banking servers that run the entire banking system, where you have your money as a digit in the account, whether it's a checking account, savings account, money market account, Visa, or even the debit cards. They're all run by the digital banking servers. They only last about 4 years and they have to be replaced. And then last but not least, we have the cryptocurrencies, the new Bitcoin. Now, Bitcoin is run by the Bitcoin miners. And due to the massive energy it takes to make Bitcoin, the heat that goes into these Bitcoin miners and the obsolescence, they last on average about 2 years. So the more technology you throw at a currency, the more fragile and weak it becomes. I would not be putting my future on these two because as energy becomes more problematic, I think we're going to have trouble with the digital banking system and the Bitcoin miners. That's why I still believe that the gold and silver will be the true store of value and currency in the future. Now, getting back to the commodity price mechanism, why it's important to understand this, because there is a floor. The one thing they do is at least provide a floor in the gold and silver price. Now, this is the estimated top primary gold and silver miners' total production cost and cost ratio for 2019. The top primary gold miners, their average was about $1,200 an ounce. That's what it took to produce gold in 2019. Now, the top primary silver miners, it was only $15 an ounce. So the ratio from gold to silver production ratio was 80-1. And that's how the market is currently pricing gold and silver. as a commodity. And it doesn't matter that there's 10 times, only 10 times more silver being produced than gold. It takes so much more energy to produce gold. That's the reason why the cost and price is so much higher. Now, if we look at this chart, I just updated it. And this is fascinating. This is a Pan America's estimated silver break even, including the estimated silver income per ounce from 2004 to 2020. Now, just like with Barrick and Newmont, in the first quarter, Pan America's production cost jumped. Now they received 16.50 an ounce, Pan American Silver did, but it lost 79 cents. So it's my estimated break even for Pan American Silver in the first quarter this year was 17.29. But if we look at the price Pan American received, and we look at this blue area, which is my estimated break even, we can see for most of the time, Pan American Silver was making money. And if we average it all together, for every year, they're making money. So if we look at gold and silver as a commodity, I don't see the manipulation. Again, the manipulation is taking place in the store of value or as money. Now, this is how Pan American Silver gets its all-in sustaining costs, which I don't follow. I think it's a bogus metric. I'm going to explain why. These are the 6 silver mines. These are the different all-in sustaining costs for the first quarter. The average was 1526. The reason why they get this lower all-in sustaining cost is due to they deduct their byproduct credits. And of all their revenues from these silver mines, only 40% was from silver. The rest was from gold, lead, and zinc. And so my estimated break even is 17.29, and Pan American says it's 15.26, and it's even higher, and I'll show you. The reason why their all-in sustaining cost has gone up, I believe, is due to the last few quarters, the base metal prices are falling for lead and zinc. And with the base metal prices falling, they can deduct less credits, which makes their production cost even higher. And this is interesting. We look at Pan American Silver's, this is their 6 silver mines right here. Their revenue was 163 million. While their production costs and royalties were 135. The depreciation was about 43 million. So they lost 14.3 million. The silver segment lost 14.3 million. The gold segment here, the 3 gold mines, actually was the winner, made almost 65 million. Now, these are the mine operating earnings. They also have to have other costs and deductions. Now, some people say, Steve, you can't go by the depreciation, that they're just writing off things that makes their costs higher. That's false. Why? Because look at their capital expenditures. A lot of times the capital expenditures are the same as the depreciation. Why? To continue producing silver, getting new mines, or replacing equipment. It's a very capital extensive operation. So a lot of times the capital expenditures that quarter or year will offset the depreciation. It's kind of a wash. So the depreciation is actually a cost. But again, here we could see that Pan American Silver lost money in its silver segment. So I believe its cost of production break even is actually higher. Now, this is a quick update on, I believe we're going to see some serious impact for the silver miners as well as the global silver supply in the second quarter, because as previously reported, Pan America suspended normal operations at its mines in Mexico, Peru, Argentina, and Bolivia at the latter part of March. Now they're starting to bring on these mines. I think in Mexico, it's going to be May 18th. In Bolivia, it's May 7th. And then in Peru, their gold mines like on May 11th. But I believe we're going to see at least a month and a half of Pan American silver production taken offline. And that's almost half. And it's going to be the same with other silver miners. So the silver supply in the second quarter is going to be much lower globally. Now, I wanted to show you a comparison why the all-in sustaining cost is a bogus metric. Again, to get this all-in sustaining cost, Pan American Silver deducts its base metal or gold byproduct credits. And if we look at First Majestic is one of the more pure plays, as they say. They have a higher silver revenue as total revenues, so they have less to deduct. They have a higher all-in sustaining cost. And then on the lower end, we have Hecla, and it's their Greens Creek mine. It's probably one of their only silver producing mines, major mines. That's why I just focused on this one mine. They have a very low all-in sustaining cost. And as we could see in the first quarter, they said that their all-in sustaining cost for silver was $7.90. Well, again, this is a bogus metric, because to get that very low all-in sustaining cost, Hecla has deducted $14.46 in byproduct credits. And we could see that right here. They deducted 16 million of zinc metal, 17 million of gold, and almost 7 million of lead, for a total of 40.1 million. Well, when you're deducting that to get this very low all-in sustaining cost, it may look good on paper. Unsophisticated investors would think that Hecla is producing it very low, but if they didn't have this byproduct credits or this byproduct metal revenue, they would be losing money. And sure enough, their Greens Creek mine only made 4.1 million. That was the net income, or the income from the operation, only 4.1 million. So again, if we look here, Hecla's total revenues, only 27% was from silver. So they're deducting quite a bit of byproduct metals to get a very low all-in sustaining cost. So my back of the envelope calculation for the Greens Creek was about 1405. It's probably higher for the whole company, so it's nowhere near the $7.90. Now, getting back to the Barrick and Newmont production cost versus gold price. If gold is going to get back down to $700, as Harry Dent says, we have to go back all the way to 2007. It was $700. Look at the production cost. It was about $600. Look at the production cost now. It's nearly 14. It may drop lower in the second quarter due to oil prices or towards the rest of the year. But how can the gold price go all the way down to 700 when the production cost is now double what it was? So, and here, this is what's interesting. As I mentioned, in 2012, the production cost for Barrick and Newmont was $1,272. The average price for gold that year, right here, was $1,669. So the margin for these two companies was about 400. Look at the margin now. Again, I thought it was going to be much less. I thought we would see a margin similar to this, but the cost of production has increased in the first quarter of 2020, and it's less than a $200 margin. So again, these analysts do not understand that the cost now to produce gold is so much higher. We're never going to go back to this period of time when the price was much lower due to the lower production cost. And in these last few charts, we can clearly see Barrick and Newmont's cost of sales per ounce of gold for these different years. And all I did is took all the cost of sales and divided it by how many ounces they produced. It was 274 an ounce in 2002. It was 1,045 in 2012, and now it's 1,353. So we could clearly see the production, the sales, the cost of sales are going higher. And it's the same for Barrick and Newmont's depreciation, depletion, and amortization. Back in 2002, they were only depreciating about $78 per ounce. In 2012, 219, and now it's 381, which means that they have to spend so much more capital to offset the depreciation and depletion. These gold mines are wearing out. They're wearing out more. They're spending a lot more to update and to offset the declines that are happening. And so it's becoming a lot more expensive. So in conclusion, we need to understand when we talk about manipulation, there's two different price functions for gold and silver. And I don't see a lot of manipulation if we look at gold and silver as commodities. but they're not commodities only. They are also money and a store of value. And this is where I do believe the majority of manipulation is taking place. The majority of the US and world's funds are in stocks, bonds, and real estate. And that's heavily dependent on oil production and energy growth. Well, we just lost a big chunk of that, and it's going to impact the value of stocks, bonds, and real estate. However, gold and silver, they are stores of this energy equivalent value. And I believe we're going to see much higher prices due to their being based as a store of value. And I will be doing more videos explaining why this is the case. Well, thank you very much for watching this newest video update. And if you have not yet subscribed to the SRS Rock Report YouTube channel, please consider doing so. Thank you.